Welcome to the Retirement Evolved podcast with certified financial fiduciary Adam Bruno.
And as always, thank you so much for choosing to listen to this with us. I am Bill Seller along with Adam Bruno. How are you, sir?
Oh, Bill, I heard the music, so I'm doing great. Just like every day I hear that music. It makes me feel a lot better.
We are back and ready to go, my friend. And Adam, tell everybody a little bit about yourself again. Let's introduce yourself. This is our second podcast together. But let folks know where you are and what you're doing.
It is, absolutely. You know, Bill, again, thank you so much for helping me with this project. I don't think I'm not technologically sound in any way, so having you here has been a huge help. But and I do want to, before I say that, I want to thank everybody for listening, of course. Hopefully you get a lot of value from this podcast and some ideas that you might not have had. My name is Adam Bruno. I'm a certified financial fiduciary, and I'm the owner of Evolution Retirement Services and Evolution Wealth Management in sunny Southwest Florida, Fort Myers, Florida. And
Adam is here to talk about ways that we can all do better through our retirement years, and especially through times like these. I mean, the world, it's just wacky right now. Everything that's going on.
It is.
One thing I saw, though, and maybe just to start out with some good news, I saw that Lego is actually bringing business here to the United States. They're going to be building a huge facility in Virginia.
I can't believe it. That sounds like great news.
Yeah.
You know, anytime that we see jobs coming back to the States, I'm nothing but excited about that.
And I'm assuming it's going to be bricks and steel, not Legos, but the building, I'm sure.
Wouldn't it be great if it was Legos?
It would be awesome.
Oh, man. And they could make it whatever they wanted. I know it, downtown Disney we're not allowed to call it anymore. Disney Springs, they have a Lego store there, and there's a big dragon out front. It would be great to, I'd love to work at a place like that.
It would be kind of weird if you came to work every week and the building was shaped differently, right? You just show up every week, and you got to find your office again because it's down a different hallway.
That's right. You start every day out with a scavenger hunt, right? Hey, where's my office today?
But hopefully that's a good sign, because we need a good sign. And, last week we were talking about the Fed raising interest rates because they just did it like a month ago, and they're probably going to do it again here before the summer's over. But, what we didn't talk about was how it's really affecting everything else around us, right?
Oh, absolutely, Bill. And we kind of get carried away. We have so much fun on this show. I'm hoping that we stay on topic as much as we can, but we talked about that last week, and the important thing to remember was, I shared my opinion that interest rates have been artificially held down since 2008, since the housing market crash. And of course, you hold interest rates down hoping to stimulate the economy and get more people to buy houses and do things like that. The problem, of course, occurs when greed gets mixed into it, right? So we had a couple years and we kept interest rates low, and everybody's thinking, oh, it's going great. We'll just keep doing this. And then, of course, 14 years later now, we're seeing the repercussions of that. You can only hold something down for so long before it explodes. And that's the idea. So when we talk about the repercussions of that, which we didn't get too much into last week, the repercussions of that. So there's been a few times in history where we've seen bonds and the market move in unison rather than moving opposite each other. If you finance 101, right? If you want safety, you buy bonds, and if you want to take the risk, you invest in the market. So many old school trains of thought are, if you're 60% risky, you put 60% of your money in the stock market and 40% in bonds, and 40% of your money's safe. Well, what we notice in periods of extreme correction is that the market does move unilaterally with the bonds there. And it happened in the 20s during the Great Depression. It happened in 2008. And it's, happening again now. We see that while the market's going down, so are bond rates. And bonds have, the performance of bonds have a direct correlation with what interest rates are doing. So as you see the 10-year Treasury kind of start to climb up, you'll notice that the performance of bonds goes down significantly. So now it's left everybody wondering, well, where can we go for safety when we talk about keeping our money safe? Because I'm willing to bet if you look at your portfolio closely, and especially for you sophisticated investors that are listening to this, if you look at your portfolio closely, a lot of you over the last 15 years would say, well, my portfolio's up, so it's okay. Even last year, people were saying this. Well, my portfolio's still up, so it's okay. The reality, though, is if you separate the investments from the bonds themselves and you just look at the bond performance, an overwhelming majority of people have seen, bonds do not climb right now. As a matter of fact, they seem to be decreasing in value. So I would say that we're in trouble when it comes to we need some safety. What do we do now? And that's what's led to so many people having hundreds of thousands of dollars in their bank accounts right now, not earning any interest. So it's just created this storm, this domino effect.
And like you said, for those listening who don't know, bonds are usually a safe option when everything else is going horribly wrong. And really, it comes down to the fact that the Fed kept the rates so low for too long. Really, that's not for so long. A lot of people are saying for too long.
Right. I'm on that train of thought. I'm 100% in on that train of thought. I think it was much too long. I think when you start to see the economy booming like it was over the last 5 or 6 years, you would expect to see some sort of interest rate hike just to keep pace with it. But again, there comes a certain point where the greed starts talking and everything seems to be going well. So, it's really a shame that we didn't take better precautions for this, and we could have probably prevented it. I'm sure that nobody would have argued with an extra 0.5% every other year or something like that. So yeah. It's just a shame.
So to follow up on what you're talking about then, if the bonds aren't an option right now, what are you talking to folks about? What is a safe way to go, or how are you guiding people through these tough times?
It's interesting because, we started talking about this 5 years ago. My partner Kurt and I, we really saw this coming and said, man, this can't sustain itself. We have to start making some kind of a transition. Even, 3 years ago, you started to see municipal bonds. And municipal bonds, whatever the interest is that they pay out, it's normally tax-free. So a lot of people like to get the required minimum distribution and then kind of reinvest it in municipal bonds. So at least what they got from it was tax-free, because nobody wants to pay taxes twice on there. You pay it on the required minimum distribution, and then you reinvest the money, and you still have to pay capital gains taxes on that.
Well, and you still need to explain to me why I get taxed on my refunds. I still don't understand how the hell all that works and why that's allowed to happen.
Oh, Bill, I wish I could help you, but I'm not a CPA.
I understand.
No, I mean, it is a ridiculous formula right now. The IRS, I always like to joke, it's when they figure this stuff out, it's on the 12th moon of the apocalypse era of, the summer solstice. As long as it falls on a Wednesday or a Friday, then it's just magic math, right? Some of these things are just ridiculous. But, back to this idea of where do we find safety now? We could buy CDs back in the day. I remember in the 90s, I had a CD that was 12%. I was super excited about that, right?
Well, yeah.
And now, I think as of today, jumbo rates were like 1.8% or something. So people are thinking, well, maybe we could do CDs. And it's not a horrible idea, but here's the other problem. Now that we've had the interest rate problem, let's talk about the inflation problem. So if inflation is at 8.6% today, every time that money stays in a bank account and isn't working for you, you're losing 8.6 purchasing power every year. 8.6%. That's a huge number.
Yeah.
Again, we've seen it in history, but we're not used to it because it's been so long, right? So what we tend to look at is we'll look at a couple different options. One of them will be creating a custom exchange traded fund for our families called a buffered ETF, or a buffered exchange traded fund. And the interesting thing about this is it's 100% liquid. We can tie it directly to the Dow or the S&P 500, and you basically put some parameters around that exchange traded fund. And when I say parameters, we'll put a 30% buffer against loss. So if the S&P 500 goes down, if the S&P 500 goes down 20%, our families don't lose any money. If it goes down 25%, our families don't lose any money. If it goes down 40% for some reason, a big correction, while everybody else's money is down 40%, our families had a 30% buffer. So 40 minus 30 is 10. So they're only down 10. But then on the upside, just like it's give and take, just like anything else, since there's a 30% buffer, you'll get a 7% cap on the gain of the S&P. So if the S&P is up 10, our families will get 7. But the reality is when we look at a bond, what we're really looking for is some safety and some consistent growth of, 4, 5, 6%. So this is a much better alternative because of the fact that it's 100% liquid, and B, you're able to really put some parameters, and those buffers can change. Heck, you can make one with a 40% buffer and a 5% cap, So we're able to really put some parameters around what our families are willing to lose. So that's one way that we stay safe. Another way is just good old-fashioned indexing. Indexing is, it could be tied to the S&P 500, and we're getting a 7% cap on the S&P 500, and we're not taking any risk. If the S&P drops, we don't lose anything. We stay at zero. So those are some very common strategies. As a matter of fact, it's something that's worked really well for us over the last 5 years, just having the ingenuity to be able to say, okay, where do we find what's best for our families? And again, that's the old fiduciary model is, you can't think about how you're paid or commissions. You have to really think about what's going to work best for the families you serve.
You said something a minute ago that made me think of, one of the old adages about investing for retirement, right? You said what our families are willing to lose. And that's what it comes down to, right? Is what is your risk tolerance? What are you willing to put up with and gamble with, for lack of a better phrase? And then work with your advisor to make sure that's the cutoff and it doesn't go past that.
And Bill, that's so important. I have met so many other people in this industry, use my air quotes again, advisors in this industry, and they really don't drill in to how their families feel about risk. They might sit with them for an appointment or two and say, I get a sense that you're really conservative. And to me, that's like, wait a minute, that's like going into a Best Buy and the guy talking to you for 5 minutes and saying, I think you're an 85-inch TV kind of guy with surround sound. How does he know? He doesn't know what I'm doing, what I'm trying to accomplish, or you buy a computer, same thing, right? Well, you need a Mac. Well, how do you know I need a Mac? You talked to me for 10 minutes. And I do put my money where my mouth is. We have a program called Riskalyze that we use, and we're very proud of it. It actually won a Nobel Prize in psychology, the psychology behind it. What it does is it basically assigns a speed limit for any family's portfolio that we meet with. It's very simple. It's from 0 to 100 miles per hour. 100 miles per hour is an ultra-aggressive investor.
Right.
I very rarely see anybody at 100 miles per hour. I'll just put it that way. But even like 75 miles an hour, that's pretty aggressive as well. So what you have to do is you have to mirror the portfolio to that person's actual speed limit that they have. And that's where it stops a lot of the times. Other advisors, other people out there, they'll see the speed limit of the portfolio and they'll say, oh, well, do you feel comfortable driving 75 miles an hour? No, that's not what it's about. You don't know what to talk about until you know how that person feels about their risk, what their speed limit is. So we have a 10 to 15 question test that we go through. It's actually a lot of fun. It feels like you're on a game show with some of these questions. And they answer the questions. And the program will generate what speed limit these families are based on their questions. So many times you could see somebody who's coming into retirement or somebody who's been in retirement for a while now, and their strategies haven't changed. So their speed limit on their portfolio is 75 or 80 miles an hour. But their feelings have changed. Their lifestyle has changed. They're retired now. So I'll do a test with someone and they'll have a 50 mile an hour speed limit. So that's way off when we talk about investment style.
Yeah.
I mean, why would they have a 75 mile an hour portfolio if their real speed limit is 50 miles per hour? So we try to quantify everything we do with families just because it's doing them a disservice to not do that, right?
Right. And just for people listening that are thinking, well, what's the difference between the stuff that you do with families and some of the big box places, right? Just the big names that we see all the time.
Oh, I love this question.
Am I allowed to mention any names or not?
You can,
for example,
I'll mention the names: Raymond James, Edward Jones,
right.
Morgan Stanley.
What is the difference between what they're doing for folks and what you're doing for people?
Those companies answer to shareholders. So that means that they're going to sell or they're going to invest their families in whatever is going to make the shareholders money. They have quotas to meet. They have different portfolios that they have to sell. I'll give you a perfect example. Edward Jones is, the founder, American funds. That's what you hear when you deal with Edward Jones. Mutual funds, American funds.
Right.
Well, Edward Jones, that's their portfolio model. So they've created that. So they're making all of that internal cost from the mutual fund. Plus the advisor is making his fee, whatever that might be, or making commission on the sale of the mutual fund. So it's just kind of a real big racket, wouldn't you think? I mean, at what point is it in Edward Jones' are they going to think of somebody else's best interest and say, hey, why don't you not look at American funds? Maybe they don't need that. Well, they only offer American funds a lot of the time. So, this whole idea of fiduciary model, and somebody can say they're a fiduciary, and they are a fiduciary for what they have to offer. Our model's a little bit different. We're completely independent, and Kurt and I designed it that way. We didn't want to have to answer to shareholders. We have our own registered investment advisory firm. We're very proud of that fact. We grew so fast. We were investment advisor representatives, and we were putting plans together with other registered investment advisory firms when we first started.
Okay.
But because we grew so fast, we had to form our own registered investment advisory firm, because any manager that manages $100 million or more has to register as a registered investment advisory firm. Well, we grew so fast that it was only a matter of time before we were going to be at that point. So we thought, well, why not do this now? And boy, Bill, let me tell you something. If you think like the housing market is regulated, if you think, I mean, this is a highly regulated industry. So there were a lot more hoops to jump through. There was a lot more red tape. I'll tell you what, I think about people who are buying their first home, and you show up on signing day and you have no idea that you've got about 540 pages in front of you to sign, right?
Right.
And it's the same thing with us. We had no idea all the regulation, but it really did put us in a good position because we are highly regulated. We know that we're doing the right things. It makes us work every day to do better, to be better, to make sure that we're covering all of our bases. And we have a lot more access to, whether it's insurance products, whether it's investments, we have a lot more access than those firms do. Some of those firms will deal with, one or two insurance companies, and it'll be high fee insurance products. It'll be things that charge, exorbitant amounts of fees. And we actually have access to all of the insurance companies. Now, we're not going to use them all because the reality is a lot of them are better than others. We try not to use any B-rated insurance carriers if we need to use insurance products. But so many other advisors out there are afraid to do everything. They're afraid to offer investments and insurance products and Medicare help and tax help. They're afraid to do all of those things because they want to just stick to what they know. And at Evolution, we have a saying in the back office, behind the scenes, where nobody can see us: don't get comfortable, because the day that you get comfortable in this industry is the day that you do a disservice to yourself, to the families you serve. You have to constantly be moving. The shark who doesn't swim dies, right? And that's
Right.
what you have to do. You have to keep moving. When you get comfortable, it's basically inviting catastrophe in for your families that you serve as well. Things don't ever stay the same in this industry for a long period of time. You can't just get comfortable with doing things one way. And then, and families will recognize this when they hear the same story. Like, especially right now with the market being down. Well, just hold on, it'll come back. Well, they're probably right. But the reality is, do those families have time for it to come back at this point? And that's never addressed. And that's the hard part. It's really the hard part about this industry, is seeing the bad habits that people have been introduced to.
And that's what makes none of this a one-glove-fits-all situation, right? I mean, somebody who's planning for retirement now that's 55 is in a much different place than somebody who's 70 watching all of this happen to our money.
That's absolutely correct. It comes down to time. There's a reason why a lot of us wear expensive watches, because it's cool and it looks great on you and you got to have a Rolex or this. Well, I wear expensive timepieces to remind me that I only have so much of it. And I have to, every day is important to building on that time that you do have. The wasted time in this industry is incredible. There is so much wasted time. And to answer your question also about how we're a little bit different, Kurt and I, how do I put this? We focus more on the institutional side of investing. So we bring our families directly to the largest institutions and the largest money managers in the world: BlackRock, WisdomTree, Avantis, Vanguard. The difference with us bringing our families there is that we're actually getting those teams behind those portfolios. Whereas you normally have to approach them at an institution level and have like $200 million to invest in that particular portfolio. I'll give you an example of BlackRock and Michael Gates' portfolio. Mm-hmm. For those of us who don't know Michael Gates, he is the individual from BlackRock who the federal government called in 2008 when everything hit the fan. So Michael Gates is brilliant, has a brilliant team, normally only deals with the institutional level of things, people that have $200 million or more to invest, right? So with our collective purchasing power, there's myself and there's about 9 other private wealth managers who all work together. We pool our resources. That's about $1.5 billion available for management. Now, in the grand scheme of things, that's nothing in the investment world, right? But for us, for just these
Sounds
private
pretty good
wealth
to me.
managers, it's pretty good for a group of guys and gals who just want to make sure people are doing the right thing. So because of that purchasing power, we're able to go directly to BlackRock and Michael Gates and say, hey, listen, would you consider allowing us to invest in these different models that you offer? And because we brought so much purchasing power, we're able to do that. My dad calls me the Costco of the finance world. I mean, so it's almost like buying wholesale, right?
Yeah, right.
But it's so important because I don't care who you are, how long you've been in business. For somebody to learn just one sector of the market and master it, just to master it, it could take 50 years. It could take a long time for somebody to master one area. So you're gonna hand your life savings to someone who is not a master in all areas of this market? To me, it makes absolutely no sense. I would rather be monitoring the managers, watching performance, making sure that I see what's going in, what's coming out. I would rather be doing those things and making sure that my families are getting the best service possible. I can put my ego aside. Yeah, I'm not going to pick you 20 winners this month. I'm going to make sure that our teams keep you consistent this month, right? That's the goal, consistency in retirement.
Well, especially when we're going through what we're going through right now. And,
Lord.
With all these the stuff that's attacking our money that we have no control over, having a plan in place and just trying to stick to that plan the best you can is the best way to get through times like these, and it never hurts to have a second set of eyes on whatever your plan is. So if that's the kind of thing you're looking for, you can check out more about Adam Bruno and his team at evolutionretirementservices.com. Talking about expensive watches and stuff, I learned years ago I'm not the guy to buy expensive stuff. I have a habit of losing it very quickly. I remember once I got off an airplane in Washington, D.C. and needed sunglasses, so I was going to splurge. This was back in the 90s, right? So I bought a $200 pair of Oakleys, which were very hot at the time, right? The blades were out, the blades were new, and everybody was wearing them. And,
you had the blades? You're really showing your age now, Bill. Yes. Were they fluorescent orange?
No, they were solid black. I didn't go any neon. But anyway, my day included a trip out on a lake on a paddleboard or on one of those, where you pedal with your feet.
Right.
And
the pedals.
Yeah, right.
Yeah.
And we get out in the middle of the lake. It gets cloudy. I put my shades in my pocket, and 10 minutes later, I hear bloop. So I owned a 200 pair of Oakleys for like an hour and a half.
Oh, Lord. Well, Bill,
I decided never again.
I just have to tell you, my timepieces are part of my legacy to my kids because I've got 4 of them now. So, I did get my son a really nice watch when he graduated high school, and I promptly called Jewelers Mutual and insured it.
Well, there you go.
That's what I do now, because if any of my timepieces go bloop on the lake, then I'm okay. I didn't lose my. Yeah. But to me, what I'm building to, and maybe one day they'll listen to this when they're actually interested. I always tell them the importance of time, because it's the one commodity that we can never get back. We can't buy more of it. So to me, it's always been a message of do what you can with the time that you're given. And to your point about, people possibly getting in contact with us, I just want to make sure we're clear on what we're not at Evolution. We're not somebody that you can call and say, "Hey, what do you think of Apple?" That's not what we do, right? I always like to describe us as CFOs. Our families are the CEOs. We're their CFOs. We advise them in everything about their retirement, their estate planning, their taxes, their investments, their Medicare, whatever it might be. But they make the final decisions. It's a collaborative effort with us. That's why we're very selective of who we actually work with directly. We try to, just like I said last time, we don't work with everybody that contacts us or comes through the door, but we help everyone who contacts us. We try and help at least. But as far as working with families, it's a very stringent kind of task, because we don't, for example, I had somebody come in 2 months ago, and he had $5 million, and it was a Morgan Stanley account or something to that effect. And he put it down on the desk and he said, "All right, so what would you do with this?" And I picked up the statement and I handed it back to him. And I said, "Here's what I do. I know nothing about you, and you're already asking me, what I would do with $5 million to invest for you. That's not what we do here. We try to help people avoid the landmines, the traps. That's what we're really here to do. And yes, we do work with people, but it's a very collaborative experience, and it's something unique and different that many people are not used to. They're not used to having to have a conversation about where they are, what their goals are, what they want to accomplish in retirement. They're not used to that. They're just used to hearing numbers and having, being sold products and saying, "Oh, look at how great this is." It just doesn't work that way with us. It's very important that everybody has a solid foundation, whether we work with them or not. Every piece of information we give them helps them to establish a solid foundation.
And really, that is what it's all about. And if you like what you've heard so far, Adam has written a great book. It's called "They Lied: The Real Cost of Retirement." And you can find it at taxfreefortmyers.com. And what made you write this book?
Actually, Bill, I got really tired of shouting from the mountaintops about all these topics that people are going to run into anyway. So I figured I got to write this down at some point. And you're absolutely correct. I want people to have it for free, and that is not, you don't have to play that back. That's the truth. I want people to have it for free. I didn't get into this business to be an award-winning, best-selling author. I got into this business to help people. So and again, I want people to have it for free, and primarily that's because I'm so mad at Amazon. When I went to go list this book, they said, well, you have to charge, money for I said, okay, well, fine. Charge, the minimum was $10 for the physical copy. I said, go ahead and charge $10 for the physical copy. But what I really like to do is offer the digital download for 1 penny. It was kind of like this brilliant marketing strategy I had, 1 cent for Adam's 2 cents,
Right.
Not that that's worth any. But they said, oh, no, it has to be 99 cents for the digital download. I'm thinking to myself, what a racket. Like, why? Yeah. What is it? How could that possibly be profitable for you? But anyway, so I found this way I created our own landing page. We also have a few other landing pages, but that one specifically keeps you updated on all the events coming up. There's a lot of great resources on that page. Everything is completely free. When you enter in your email, of course, you'll continue to get different things from us. I don't overload people's emails, though. I just kind of send out different articles, things like that are interesting, that I find interesting about retirement. And it's a great resource. So you can go to taxfreefortmyers.com. That's tax-free, FORTMYERS.com. All you have to do is enter in your email address and it'll instantly download for you on whatever device you're on. It is compatible with phones, computers.
The book is called They Lied, The Real Cost of Retirement, and answers the biggest question we all have, which is, why didn't I know that about my retirement money? So get Adam's book at taxfreefortmyers.com. I can't believe we're out of time already, man. Every time we get together and do this, time just flies, but I always learn so much, Adam.
Oh, thanks, Bill. And I'm sorry if I took over too much there. You get me going, and it's like, ooh, the passion takes over, and I don't know. It's not that I like to hear myself talk, believe me, because I would rather listen to you than me with that wonderful radio voice that was gifted to you.
Yeah, okay, all right. That's definitely time to go now. So, you're too kind. You are too kind, my friend. Until next time, enjoy yourself, and we will talk soon.
God bless everyone. Thanks so much for listening. Can't wait to talk to you again soon, Bill.
Investment advisory services are offered through Evolution Wealth Management Incorporated, an investment advisor registered with the state of Florida. Registration does not imply any level of skill or training. Evolution Wealth Management's unique CRD number is 307644. You can obtain a copy of Evolution Wealth Management's firm brochure, Form ADV Part 2A, free of charge by visiting advisorinfo.sec.gov. Evolution Wealth Management offers investment advisory services only, where it is appropriately registered or exempt from registration, and only after clients have entered into an investment advisory agreement confirming the terms of engagement and have been provided a copy of the firm's ADV Part 2A. Insurance services are provided by Evolution Retirement Services. Any guarantees mentioned are backed by the financial strength and claims-paying ability of the issuing insurance company and may be subject to restrictions, limitations, or early withdrawal fees, which vary by the issuer. They do not refer in any way to securities or investment advisory products. You should consider the charges, risks, expense, and investment objectives carefully before entering a contract. This material has been prepared for informational purposes only and should not be construed as a solicitation to affect or attempt to affect either transactions in securities or the rendering of personalized investment advice. This material is not intended to provide and should not be relied on for tax, legal, accounting, or other financial advice. Evolution Wealth Management and Evolution Retirement Services do not provide tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Evolution Wealth Management and Evolution Retirement Services are affiliated entities.